Good evening, everyone. Thanks for tuning in. This is the A.L. Johnson Life Insurance Masterclass. My name is A.L. Johnson, the owner of A.L. Johnson Life Insurance Agency. I've been a life insurance broker for the past 13 years. I've helped thousands of families, and this is really my passion. And so when it comes to helping families with life insurance, that's exactly what I do. One of the things that I really enjoy doing is educating families because I understand that a lot of times the education that you need isn't readily available. And so that's what I'm going to provide for you here today. For those of you that don't know, September is Life Insurance Awareness Month. And so over the course of this month, I'm going to be making several videos to make sure that you have all the information that you need. And so today I'm going to go in, I'm going to break down the three major types of life insurance and how they work, also how they can benefit your family. But before I get into that, I'm going to give you a quick 3-minute history lesson on why life insurance is especially important for first generation wealth builders as well as low income households. And so we're going to jump into that right now. Also, this is a actual live streamed event. And so if you have any questions, you can leave those in the comments section and I'll be sure to address those. So when we talk about generational wealth, we first have to go back and look at the wealth disparity. This is extremely important. And so for those of you that don't know the man in the picture, you possibly know his name, J.C. Nichols. And so I was born and raised in Kansas City. If you were as well, you're familiar with the name J.C. Nichols. Well, when it came to real estate and the opportunities that were available for low-income Americans, specifically Black Americans, there were covenants that were created that did not allow us to purchase homes in highly appreciating neighborhoods, right? And so when you look at the wealth gap, real estate redlining was a huge part of that. But one overlooked fact that a lot of people miss is there was also redlining in life insurance. And so the way that worked, as a Black person, you literally got a third of the coverage of anyone else for the same price. Some companies, the disparity was as much as 3 times the amount of coverage for the same price. Well, how did that play out over time? Well, if you think about it, when someone in our neighborhoods would pass away, we would have just enough money for funeral expenses. And that's why today a lot of people only look at life insurance as a way to pay for a funeral. All right. When our counterparts passed away, they were leaving enough money for their family to purchase homes, to buy real estate, to invest in the stock market. And so every generation, that wealth gap became wider, wider, and wider. During civil rights, they actually lobbied to make sure that companies could not discriminate by pricing. Well, what ended up happening there was, and you can look this up, a lot of the life insurance companies stopped selling in lower income or Black neighborhoods. And so it's not about it being a Black or a white thing, because if you were white, Black, or brown, if you were lower income, you generally lived in the same neighborhood, and they started redlining, right? And so now, although exclusion created the missed opportunities that were created the wealth gap initially, now it's a matter of miseducation and a lack of knowledge that really keeps it going. Now, when it comes to generational wealth building, we have to understand that there are 4 major ways to do that. And I like to imagine a stool, right? The more legs of the stool, the sturdier, the stronger that stool is, the safer it is, and the more likely it is to be able to support you. And so when we look at those 4 pillars or legs of the stool, we have business, stocks, life insurance, and real estate. This is how we build generational wealth. Well, my focus is life insurance. I'm going to give you a few reasons why life insurance should really be the base of your generational wealth plan. So first of all, life insurance is the only vehicle that you're able to transfer wealth to your family tax-free. Any of the others that I mentioned, they'll be taxed, and so they won't get the exact amount that you want. Life insurance guarantees a specific amount that your family is going to receive. And so it isn't subject to market crashes like stocks or real estate. When you take out that life insurance policy, whatever that amount is that's guaranteed for your family, it is guaranteed to be that exact amount, free of taxes. Another great benefit to using life insurance as one of your generational wealth building plans is that you can name multiple beneficiaries even at varying percentages. This is extremely important. Over the years, I've seen a lot of arguments over the selling of property because you can't split a property in half and sell it, right? And so there has to be people coming together making that same decision for it to happen. With life insurance, you can set aside a specific amount for members of your family. And most importantly, the money that your family receives can be used for literally anything, right? So it can be used to pay off a home. It can be used for funeral expenses. It can replace income, and it can do so much more. So life insurance is extremely important. Now, here's the part where a lot of us tend to make a mistake, and there's just really a lot of undereducation and miseducation. There are three types of life insurance. So I'm going to go through those and exactly how each of those works. First, I'm going to start with your term life insurance, which is the most common. Most of the commercials that you see advertise term life insurance. And so if you're taking notes, I want you to write this down. The quickest way to understand how a term policy works is that it terminates. And so it is a temporary policy that will terminate in the future. Nothing wrong with that, but you have to understand that if you are purchasing a temporary policy, it should be purchased for a temporary need. An example of a temporary need would be a mortgage that you have for 30 years. You can get a term life insurance policy to cover that amount. And once the mortgage is paid off, you no longer need that term insurance. You're okay with it terminating because the reason that you purchased no longer exists. If you're raising small children and you want to make sure that you can replace your income if you pass away while they're young so that someone else can, take care of them until they become adults, you're okay with that term policy going away because the need is no longer there. And so when you purchase term life insurance, you want to ask, how long does the policy last before it terminates? With most companies, it's going to be 10, 15, 20, or 30 years. Some will even insure you to a specific age like 65 or 80. It's very important to know. Now, term policies do not build a cash value. Why is that important? Well, the cash value in a policy is called a non-forfeiture value, right? So that just means that if for some reason you did have a policy that accumulated cash value, you hit a rough spot, you couldn't make a payment, those non-forfeiture values kick in and can make the payment for you, or you can take a reduced paid out benefit for your family. With term, that doesn't exist. Now, the benefit of that is term is going to inherently be cheaper because there's not that cash value benefit. So it allows you to purchase more life insurance coverage, which is extremely important. Most families literally do not have enough coverage, especially families that have small children. And so when you need a large amount of coverage, you want to consider a term life insurance plan. Now, depending on the company, your term life insurance can be converted to a permanent policy at any time, or it can be renewed so that you can extend the life of the policy. So for example, if you started off with a 10-year term life insurance policy, at the end of that 10 years, your policy would expire. However, if the company allows you to renew the policy, then you can extend that for another 10, 15, 20, or 30 years. The key consideration here is that your life insurance price is going to be based off of your age on when you renew or convert, which can be a drastic difference. And so when you're looking at controlling your costs with life insurance through term life, that's a major consideration. So you want to ask your agent, hey, at the end of this term, what will my renewal price look like? Very, very important question. Also, with the newer term life insurance policies, they have a very important benefit. It's called an accelerated death benefit. The way that works is if you ever had anything like a heart attack, stroke, cancer diagnosis, were ever confined to a nursing home or anything like that, you can actually take a portion of your policy death benefit while you're still living. So it almost doubles as like a long-term care policy. Really important. Now, our next type of policy that we'll go over is whole life insurance. I know a lot of you are familiar with that. Generally, you're going to hear about whole life insurance with people who are older in our community, right? They're just looking to take care of their final expenses, funeral arrangements, and maybe just a little something to leave behind for the family. What's great about whole life insurance is that it's permanent, so the policy can't be outlived, right? If we contrast that with term, and a person has a term life insurance policy that carries them to the age of 65 or even 80, a lot of times that puts them in a really tough situation if the policy can't be converted. Why? Well, the older we get, we tend to have health issues. So cancer, heart attack, stroke, diabetes, these things become a problem when it comes to getting additional coverage. And the price is quite a bit higher. And so when it comes to your whole life insurance, I encourage people, if you're considering it, to look at it when you're as young and as healthy as possible, to go ahead and lock in that rate so that you can have that coverage that is not outlived. The next thing is your whole life policy is going to be designed so that it builds a cash value, right? And so you always hear about cash value life insurance. What you can do with that cash value, one, is it's a support for the policy. And so, as I said before, if you ever hit a rough spot and needed to pull from your cash value in your life insurance policy, it's a source of money that you can touch with no credit check or anything like that. Sign a piece of paper, the insurance company sends you a check, it's your money. Now, if you were to pass away without paying that back, they do subtract whatever you've taken out from the eventual death benefit that your family will receive. Also, that cash value acts as equity, just like when you purchase a home. And so as you make your payments, you own a portion of the equity in your home. So when you sell it, that's a profit to you. Well, with your life insurance policy, as you continue to pay into that permanent whole life plan, you're actually building equity. And so say if you bought a $50,000 policy, years down the line, you may have $25,000, $30,000 paid up. If you did want to continue making payments, you could stop making payments at that point, and the insurance company will reserve that $25,000 or $30,000 for your family whenever the time comes. It's a great, great benefit. And just like the term policies, many of the newer whole life policies do have the accelerated death benefit, which pays out in the event of any major illness or nursing home confinement. Now, there is a third policy type that you rarely hear about, but it has been talked about a little more lately. Some people use it as a wealth building tool. I'll explain that. But this is your universal life insurance. The way that I remember that is it's universal, just like a universal remote. It works with any TV, just like universal life works in any situation. It's a policy that you can actually customize to fit your exact needs. Now, if you're looking for permanent insurance and you've kind of heard the line that says, well, purchase term and invest the difference. Generally, they're contrasting that with the traditional whole life policy, which costs dramatically more. Universal life insurance can actually be designed to last your entire life, but it doesn't have to have the cash value component. That's extremely important because it lowers the price dramatically. And so it's like a midpoint between term and whole life from a price perspective. But what's great is if you're looking to build long-term generational wealth and you're a first generation wealth builder, this guarantee of permanent life insurance is a must in your plan. As I stated before, the stock market, the real estate market are definitely a part of the four-legged stool for generational wealth building, but they're not guaranteed. You can't guarantee a specific amount. And the market crashes, as we've been seeing this year, as we saw in 2008, 2009, as we saw back in 2000, back in the 70s. Depending on when you retire or pass away, you may have dramatically less than you expected. And so permanent insurance is really a way that you can guarantee a specified amount to your family and for future generations. Now, if you decide to overfund the policy, meaning that you're paying more than the cost of insurance and you want to make an investment, you can actually have a side account that's linked to the stock market, an indice such as the S&P 500. And this allows you an opportunity to actually generate more cash value than you can in a traditional whole life insurance policy. But the main thing that you want to know about your universal life policy is that you're in full control of that. It isn't built into the premium. You can pay the lower premium and make it a permanent policy, or you can pay a bit more if you do want to accumulate funds inside of the policy. Now, so here's a few of the frequently asked questions. And then after this, I'm going to go ahead and jump in the comment section. If anyone has any specific questions, I want to be able to answer those for you. But one question that I get a lot is, do life insurance companies accept pre-existing conditions? This is the number one reason why I became a broker. So when I first started selling life insurance, I worked for one company as an agent. And the next company that I worked for, I worked my way into mid-level management. I was a regional director for a company. But when working with one company, I always ran into situations where I couldn't help the clients in the best way possible. Whether it be I didn't have all of the different policy types that I just educated you on, or they didn't accept the pre-existing conditions that I was running into. So there are companies that don't accept diabetes. There are companies that don't accept heart attacks, strokes, or cancers. Some companies have different look back periods, and so they may look 2 years, some may look back 10 years. And so as a broker, I'm able to search all of the companies and match them to your health. And so to answer the question, yes, there are companies that do accept your pre-existing conditions. The next question that I get a lot is, should I cover my children as a rider? And so if you have a policy now and your agent said, well, hey, we're going to go ahead and put your children on a rider and maybe you pay $5 to $10 a month and it covers all of your children. That's what a rider is. So they're attached to your policy to a certain age, usually 18, 21, or 25, depending on the company. This is a good cost-effective way to cover your children if you have multiple children and you're budget conscious. However, that may not be the best thing to do for your children. For a child, you may consider purchasing a whole life insurance policy. The reason I say that is because, again, life insurance is based on your age and your health at the time that you take out the policy. And so the younger and healthier you are, the cheaper it is. For example, a 5-year-old child can get a $50,000 policy for about $20 a month. If you do the math on it, it would take about 100 years to just pay $25,000 into the policy. And so the value is definitely there. It's building cash value for them. So if they have any emergencies in the future as an adult, that'll be there for them. But also, you're not just prolonging the inevitable. When you put your child on a rider, just know that at 21 or 25, you're going to have to convert that policy or take out a new policy at a higher premium. The next question I get, can I purchase insurance for a relative? Absolutely. So in insurance law, you can purchase a life insurance policy on anyone that you have an insurable interest in. That means it can be a relative, like your spouse or one of your children, a parent even, but it can also be a business partner. Say if you had a policy to make sure that, if something happened to one of your business partners, there's money there to take care of inventory, to pay employees, or to keep the business going. That is something that you can do as well. The next question I get, can I have more than one policy? Yes, absolutely. And I actually suggest it for most people. And here's why. As I stated earlier, you have your term insurance that's temporary and it's the cheapest form of insurance. And so you absolutely want that for something large, like your mortgage, or to make sure that you leave enough behind for your children. But when that policy runs out, you're still going to need something. And so what I tell my clients is, if you're young and you're healthy and you can afford it, you want both types of coverage. Whether you do the permanent through whole life or universal life, that's up to you. But you also want that term policy that can really just cover everything. Right? As far as a waiting period, huge question that I get, and I work with several funeral homes across the country. One thing that they say that happens a lot is they have people that come in with life insurance policies expecting them to pay out. And the number one reason that the policies don't pay out is because a person had a waiting period that they were unaware of. The way that works is, if you were to pass away in the first 2 years of purchasing your policy, the life insurance company will only refund the premiums you've paid plus a little bit of interest versus paying the actual death benefit. So when does this apply? A waiting period is put on any policy where they don't ask any health questions. And so when you're watching television and you see a commercial and they say, hey, this new life insurance plan, no health questions asked, just fill out this form, send it in, and you're covered. Because the life insurance company knows nothing about you or your health, they impose a 2-year waiting period. Also, if you have significant health challenges, meaning recent cancer diagnosis, recent heart attack, recent stroke, diabetes under the age of 50. In a lot of those situations, they will impose a 2-year waiting period. After the 2 years, the policy acts just like a normal policy, but it's something you 100% want to be aware of. And for anyone who's watching this, if you have parents over the age of 50 and they purchased life insurance recently, that is something that you want to make sure that you review so that you know. Now, just one real quick note, there is something called a contestable period that is also 2 years, but it works a little different. This is on all policies, whether you're young, old, healthy or not, term or permanent insurance. All policies are contestable for the first 2 years, meaning that if there was information not disclosed in the life insurance application, or there were lies or misstatements, the insurance company does reserve the right in the first 2 years to go back and check everything to make sure before they pay out. So there's a slight difference. A waiting period is an indefinite 2-year wait. A contestable period is we're going to check and make sure that everything was right on the application when we took it out. Another question that we have is, should I leave my minor children as a beneficiary? I get this question all the time, especially when we have, single parents who are, just wanting to make sure that if something happens, there's life insurance money there for their children. Well, here's what you have to consider. If your child is under the age of 18 when you pass away, they can't claim the life insurance benefit. The money doesn't go away, but it does go into probate, and then they'll have to go through that process once they've come of age. Once it goes into probate, there's a lot of fees involved, and your child won't get the full amount that they need. Furthermore, if someone needs to take care of your child, they're going to need money to do that. And so if you leave it to your child, they have no way to access that. And so what I always tell people is to go ahead and assign a beneficiary, someone that you can trust. Whoever's going to be taking care of your children, have them as the beneficiary until your children come of age, and you can always change beneficiaries. Another question we get, do I need life insurance if I have coverage on my job, right? Who wants two bills? They're taking a little bit out of your check at work, and now you're going to get life insurance outside of that. Well, here's the answer. You absolutely want to have life insurance outside of your job. Here's why. One, it isn't mandated for your employer to keep life insurance benefits intact. There are no laws regulating that. So at any point in time, your employer can take away that benefit, and now you're suddenly without coverage. Another thing that you want to consider, the average person switches jobs now every 5 to 7 years. When you leave your job, you generally can't take your life insurance with you. And so every time you switch jobs, you're having a period where you have absolutely no coverage. And we never know when something might happen. And so that's not a good thing. We also don't know when something may change in our health. And so in between jobs, if you have a health event that disqualifies you for life insurance or dramatically reduces your options, that's not what you want. And so while you're healthy, while everything is good, that's when you want to purchase your own personally owned life insurance that you own and control 100%. I'll share a little story with you, and you can Google this, just make sure that I'm right. But Sears, at one point, was the largest retailer in the world, just like Walmart, right? Just a few years back, not very long ago, they cut the life insurance program for all of their retirees. Tens of thousands of people lost their life insurance at the drop of a dime. And these are people in their 60s, 70s, and 80s. Could you imagine that? And so you want to make sure that you own your own policy. Next question. What determines the price of my life insurance? This is important. So one, it's going to be based off of your age and your health, but there are a couple other considerations like what policy type. Again, term is going to be your most affordable, then universal life, and then whole life. In addition to that, they can increase your premium based on medications that you take. Occupation is one. And so if you have a dangerous occupation like a firefighter or a police officer, some companies will rate you up for that. If you smoke or use tobacco, that's another consideration. And some companies do look at your driving history or criminal record, and that can raise the price of your life insurance as well. Now, will you need to take an exam? Do I have to take a physical? Is somebody going to come and take my blood and prick me and poke me and all those things? So here's the answer to that. You don't have to take a physical to get most life insurance. Now, with most companies, like I said, as a broker, I'm able to see the majority of them. They will have limits that if you go over, they require an exam, which makes sense because the insurance company has to protect itself. A rough number that I see with a lot of companies is about $500,000 and under you can generally get without an exam. Once you go over that amount, a lot of companies will require an exam. Another note with taking an exam. Generally, there's an option for what's called express underwriting, where you just answer some health questions. The insurance company will check your records, and as long as nothing pops up, they'll go ahead and give you coverage. There's also the opportunity to take an exam and lower the price of your coverage, right? And so if you know, hey, I'm 100% healthy, I've never had a health scare, I don't take any medications, you might want to take an exam because you can actually get a preferred rate, which generally is much lower than what you generally see advertised. And so those are some of the most frequently asked questions that I get. I'm going to take a quick minute and go through some of the comments here. All right, dinner and dialogue. Could I purchase term life insurance for a relative, or is that just recommended for whole life? Good question. You can purchase term or whole life for a relative, and so it can be any policy type. Also says here, I want to purchase life insurance on my daughter and son-in-law, naming their children as beneficiaries. Can I do that? Absolutely, absolutely. 3 and 4, it's definitely the long game, though. Yes, it is the long game. When it comes to permanent life insurance, whether it's whole life or universal life, it is a long game, but so is generational wealth building, right? And so when you purchase a home for an investment, that's the long game. When you purchase stocks, for retirement or to pass on to the next generation, it's the long game. And so when we talk about generational wealth, none of it is get rich quick. None of it happens immediately. But if we don't go ahead and start taking the proper steps, then our community stays in the exact same place. As I said before, previously, we were locked out of the opportunities that life insurance provides to have that tax-free benefit that goes to your family so that they can take advantage of the other 3 legs of the generational wealth building stool. And so that life insurance that you're paying for now, the long game is one day your children will be able to take those proceeds and purchase real estate, purchase stocks, purchase businesses. And that's really what it's all about. And so if you've been watching this and you say, hey, I've got a couple questions, as I committed to before, this isn't a sales pitch at all. I just want to provide education. And so what I would say is review your current life insurance policies. You want to see what type of insurance you have, how long it lasts, and the amount of the death benefit. You also want to verify the ongoing costs, meaning if you have a term life insurance policy that you know is going to expire at some point and you'll need to renew it, you want to know exactly what that cost is going to look like. Second, you want to review your current and anticipated expenses that you'd like to have protected with life insurance and verify the total amount needed. The average American has a huge shortfall when it comes to the amount of coverage they actually need. And so you want to review that. And then last but not least, consult with a professional. And so take this video, go back, rewind it, pause it, restart it, take notes. But before you speak with a professional, make sure that you have your list of questions ready so that you aren't blindsided or purchasing the wrong type of policy. That's been very forward. Thank you. And so, hey, everyone, thank you so much for watching. Again, this is September. It's Life Insurance Awareness Month. And so I'm going to do a couple more of these. If you end up having any additional questions, you can visit me at aljohnsongroup.com. You can also contact me directly at 913-279-1463 or send me a personal message right here on Facebook. I'm happy to help. I thank you all for tuning in. You have a great evening.